Welcome to Ticker Watch News for Amazon, Week 4 of 2026. Is the era of absorbing costs over for the e-commerce giant? This week, Amazon's CEO delivered a stark warning to shoppers about rising prices, signaling a shift in the company's ability to shield consumers from tariff-related inflation. At the same time, reports surfaced of massive corporate layoffs driven by artificial intelligence, painting a picture of a company aggressively streamlining its operations. While Wall Street bulls are eyeing a grocery revolution in advertising growth, the immediate reality for employees and customers looks increasingly turbulent. This is Ticker Watch News for Amazon, Week 4 of 2026. This episode covers the news and developments for Amazon from the week ending January 25, 2026. Let's begin with a snapshot of how the stock performed over the last 7 days. It was a volatile week for Amazon shares, reflecting a tug-of-war between bullish analyst revisions and macroeconomic concerns. By the close of trading on Friday, January 23rd, the stock had seen upward momentum, trading near the $240 mark. This represents a recovery from earlier in the week. Shares had dipped on Tuesday, closing down over 3% at $231. However, by the end of the week, the stock had pushed back above its 21-day moving average. So far in January 2026, the stock is up roughly 3%, outpacing its performance from last year. While the broader market has been reacting to shifting tariff policies and inflation data, Amazon's ability to hold the $230 support level and climb toward $240 suggests resilience among investors. Now let's unpack the major stories that drove the narrative this week. First up, the impact of tariffs in inflation took center stage. On January 20th, Reuters reported that Amazon is beginning to see tariff-related price spikes on its e-commerce platform. For months, the company had managed to keep prices steady by pre-buying inventory, essentially stocking up on goods before new costs kicked in. However, in an interview with CNBC, CEO Jassy revealed that this inventory buffer ran out in the fall of 2025. Jassy noted that while the company tries to work with selling partners to keep costs low, they don't have endless options. Consequently, sellers are gradually passing these higher costs on to consumers. This marks a significant tone shift from July 2025, when Jassy had downplayed the impact of tariffs. The concern now is demand elasticity. Shoppers are becoming increasingly bargain-focused and hesitant to purchase higher-priced discretionary items. Interestingly, the tariff situation appears fluid. While the CEO warned of price hikes, a separate report from January 13th noted that Amazon had been in conversations with suppliers regarding price adjustments in response to lower U.S. tariffs on Chinese imports, specifically a reduction in the average tariff from 57% to roughly 47%. This complex landscape of fluctuating trade costs is creating a challenging environment for the retail giant's pricing strategy. Moving to corporate operations, a major restructuring is underway. Reports from late in the week indicate that Amazon is planning a new round of corporate layoffs slated to begin as early as next week. According to Reuters, these cuts could affect approximately 14,000 to 15,000 employees across various departments, including cloud computing, retail, Prime Video, and human resources. This move is reportedly part of a broader strategy to eliminate roughly 30,000 corporate roles. Management has cited artificial intelligence as a key driver for these reductions, stating that AI and automation have made certain roles redundant and are enabling the company to innovate faster with fewer overlapping management layers. This aligns with previous reports that Amazon does not intend to grow its U.S. workforce, even as it plans to double its product count over the next decade. In more positive news for the company's growth, Amazon is making a significant play for the grocery market, directly challenging Walmart's dominance. Data from Morgan Stanley and research firm Numerator released this week highlights a surge in Amazon's fresh and perishable food sales. In the second half of 2025, sales of meat and produce on Amazon reportedly doubled year over year in some weeks. This acceleration is broad-based, spanning lower, middle, and higher-income households. the revamp of Amazon's grocery offering, which now allows Prime members in certain cities to order perishable groceries for same-day delivery alongside standard retail items, appears to be driving repeat behavior. While Walmart still commands over 21% of the grocery market share compared to the single digits for Amazon's various grocery banners, analysts view this momentum as a signal that Amazon is successfully bundling groceries into its ecosystem. Finally, on the infrastructure front, Amazon Web Services, or AWS, is aggressively securing resources for its data centers. On January 15th, it was reported that AWS finalized a deal with mining giant Rio Tinto. AWS will utilize copper from Rio Tinto's operations in Arizona for its data centers. This partnership highlights the critical need for raw materials to support the booming demand for AI infrastructure. Additionally, CEO Jassy committing to self-funding the massive energy needs required for this AI expansion. Speaking at Davos, Jassy stated that the company expects to fund its own power, including investments in nuclear capabilities and renewables, rather than passing infrastructure costs to utility ratepayers. This comes as AWS also launched its European Sovereign Cloud earlier this month, a completely independent cloud located within the EU, designed to meet strict regulatory and data residency requirements. Let's turn to how the market and analysts reacted to these developments. Despite the warnings on consumer prices, Wall Street sentiment remains largely bullish, particularly regarding the company's high-margin businesses. TD Cowen reiterated a buy rating this week and raised their price target to $315 from $300. Their optimism is fueled by an advertiser buyer survey indicating that 60% of advertisers plan to increase their spending on Amazon in 2026. The firm projects Amazon's ad revenue will more than double to over $141 billion by 2030, driven by generative AI creative tools and the expansion of its demand-side platform. Wells Fargo also maintained an overweight rating, boosting their price target to $301. They cited favorable revisions for AWS in 2026, supported by a planned doubling of compute capacity through 2027. They named Amazon their top internet pick for the year. However, not all adjustments were upward. Raymond James reduced its price objective to $260 from $275 on January 15th, though they kept an outperforming rating. This reflects some caution, likely tied to the retail margin pressures discussed earlier. Morgan Stanley maintained an overweight rating with a $315 target, specifically pointing to the grocery sector growth as a catalyst for potential multiple expansion. In terms of valuation, the mean analyst estimate currently sits around $295, implying a potential upside of over 25% from current levels. However, discrepancies in fair value estimates remain wide, with some models placing fair value as low as $208 and as high as $450, underscoring the uncertainty regarding how tariff costs and AI investments will ultimately impact the bottom line. Now for a quick technical and fundamental check-in. Technically, the stock regaining its position above the 21-day moving average is a positive signal for short-term momentum traders. The recovery from the Tuesday dip suggests strong buying interest around the $230 level. Resistance likely sits near the recent highs, and a breakout above $240 could open the door toward the analyst targets in the $300 range. Conversely, if negative macro news hits, that $230 support will be critical to hold. Fundamentally, the narrative is shifting from a pure e-commerce story to one of AI efficiency and advertising dominance. The bullish case rests on the three pillars: AWS, advertising, and e-commerce. The news this week strengthens the advertising and AWS pillars, with ad revenue projected to double and AWS securing long-term power and copper supplies. However, the bear or risk narrative is centered on the core retail business. The admission that tariff costs are now raising prices puts pressure on retail margins and could dampen consumer demand. Furthermore, while layoffs reduce costs, they also signal a major operational pivot that carries execution risk. The company is essentially betting that AI can replace human headcount without disrupting operations. So, what should investors watch out for in the week ahead?
The most immediate catalyst will be the reported layoffs. If reports are accurate, Amazon will begin cutting thousands of corporate jobs starting next week. Investors should watch for official announcements regarding the scale and specific divisions affected. While cost-cutting is often viewed favorably by the market, the morale impact and any signs of operational disruption will be scrutinized. Secondly, earnings season is approaching. With quarterly results due in the next few weeks, the market will be looking for concrete guidance for Q1 2026. Specifically, watch for any updates on the tariff-related price spikes mentioned by the CEO. Will the company quantify the impact on guidance? Also, keep an eye on the grocery sector competition. With Amazon making inroads into perishables, any countermoves by Walmart or data from competitors like Instacart could influence sentiment. Finally, monitor the price action around that $240 level. A decisive close above it next week could confirm that the market has digested the tariff warnings and is focusing on the long-term AI and advertising growth story. To wrap up, here are the key takeaways from this week. First, consumer prices on Amazon are rising. The inventory